Hello everyone, welcome to chapter 21. In this chapter, we'll be diving into the intricacies and the different details of intraday trading, what it's about, how it works, and why it's such a popular and appealing style of trading among many traders. By the end of this video, you'll have a solid understanding of what it actually takes to succeed as an intraday trader. We will cover topics such as what are the different time frames involved. We'll talk about both the higher time frame and lower time frames. We'll talk about the key differences and the core differences between intraday and swing trading. We'll go over why these two styles cater to very different kind of traders. And then we'll talk about the paradoxes and myths of intraday trading. And then last but not least, we'll discuss the objectives and goals of an intraday trader. We'll get into the mindset of an intraday trader. What are they trying to achieve? We'll talk about the realistic expectation that you need to be aware of and how to actually define the daily candle range. And just like I said before, by the end of this chapter, you'll have everything you need to know about intraday trading and you'll be able to decide whether it's for you or not. Now let's move over to the next slide and let's talk about intraday trading. So intraday trading, or what some people also call day trading, is all about opening and closing your trades within the same day, right? You're not holding anything overnight or over the weekends. You are in and out all within one single trading day. The whole idea is to profit from price movements happening within a single day, right? Which means you are taking advantage and capitalizing on the daily range expansions or the expansions or reversals that occurs within a single daily candle, right? You're basically saying that I don't care where the market ends up tomorrow. I'm just here for today's price action, right? That is the main premise of intraday trading. Now, let's talk about how intraday trading differs from swing trading, right? Now, I know that they're both about making money, but when it comes to the approach and mindset that is needed for each style, they're totally and fundamentally different from each other in every aspect, right? Intraday traders don't mess around with holding trades after the market closes, right? You are done by the end of the day with no position at all. On the other hand, swing traders, they're gonna hold trades overnight, over the weekends, or sometimes even longer because their trades takes more time to pan out. For intraday trading, your objective and main goal is capturing the daily price range. You are targeting to capitalize on the daily range expansions within a single trading day. While on the other side, swing trading plays the longer game. They focus on the weekly price range and tries to exploit or capitalize on the weekly range expansions, right? Where it takes a bit more time to develop. Now, here is the thing. Intraday trading is for those traders who thrive on quick decisions and have the mental capacity to sit in front of a screen, watching the charts and actually ready to act in the heat of the moment, right? They know how to compose themselves in high stress environment and cannot be easily distracted. On the other hand, swing trading is better for those traders who are actually chill about holding position overnight or over the weekend without freaking out. For example, if you are someone that loses sleep thinking about what the market might actually do while you are asleep, then maybe swing trading isn't for you. But if you can trust your analysis and stay calm while holding trades for days or even weeks, then maybe swing trading could be a great fit for you, right? There are so many other metrics as well that you have to consider before deciding which trading style is more suitable for you. But we will discuss them in the next chapter about swing trading, so you have everything that you need to know of. Now, let's move over to the next slide and let's discuss the myths or paradoxes of intraday trading. A lot of people get the wrong idea about intraday trading, right? So let's set the record straight. So here is the first big misconception. People think that intraday trading leads to quicker results just because the trade themselves are fast, right? Like you are in and out in a few minutes or hours, so naturally you think that you should get successful faster, right? Wrong. The truth is, no matter how quick your trades are, you're still going through the same learning phases and challenges that any other trader, like a swing trader or position trader, goes through. There's no escaping the process. You've got to learn your strategy, practice discipline and consistency, understand risk management, and build the confidence over time. There's no shortcut to success in trading. Whether you hold your position for a few or several days, the effort, time, and energy you put into mastering your craft are the same, right? So if you are getting into intraday trading thinking that it will make you successful faster, then you are setting yourself up for disappointment and failure, because it's still a journey, not a sprint, right? And you have to consider that at all times. Now, here's another big one: the over trading trap. The idea that more trades mean more profit is completely wrong, right? You think that if I'm trading all day, taking every opportunity, I'll make more money, right? Now, that's not just a myth, it's dangerous thinking. Over trading is one of the fastest ways to drain your account. Why? Because, first of all, higher cost. Every trade comes with transaction cost, commissions, spread, and slippage. So, the more trades you take, the more these cost eats into your profits. The second one is that overtrading leads to increased mistakes. When you are taking too many trades, you are more likely to act impulsively and ignore your strategy and system. And that's when error starts piling up. The third one is that overtrading put unnecessary pressure on your emotional state, which leads you to frustration and bad decision making. The reality is that trading less but with precision is always better, because after all we know that it's about quality rather than quantity. In intraday trading, the goal isn't to be glued to the screen all day taking every single possible trade or opportunity. It's to identify high probability setup, take them, and then take a step back, right? So, just because you are trading more frequently doesn't mean you'll make more profit. That's a straight up lie, and falling for it can be a costly mistake for you. Now, intraday trading might seem fast paced and exciting, but don't let these myths fool you, right? Quick trades doesn't mean quick success, and more trade doesn't mean more profits. And to actually succeed, you have to focus on building your skills, sticking up to your strategy and system, and trade with precision. It's all about playing the long game even in the short term world of intraday trading. Now, let's move on to the next slide and let's break down the key points about intraday trading. And this is where we will get into the core principles that will guide you as an intraday trader, what to aim for, what to avoid, and how to make the most out of each trading day or each trading session. Right? Now, first of all, let's talk about the goal of an intraday trader. Our goal is capitalizing on the daily range expansion, right? The main objective of intraday trading is simple. You are here to make money from the price movements that happens within the same day. Specifically, you are looking at the daily range expansion and capitalizing on it. Your job is to stay sharp, recognize those setups when they happen, and execute with precision, right? But don't ever let this confuse you with chasing every little swing, right? It's about capturing high probability part of the range and not every single pip or tick. Number two, you don't trade every single day. Uh, there's a big misconception about intraday trading. People think that being an intraday trader means you're trading every single day without fail. And no, that's not how it works, right? Not every day is ideal for trading. Some days the market is choppy, the setups are unclear, or the volatility isn't just there. And on those days, the best decision you can make is to sit out and protect your capital, right? Remember, you're not paid to trade, you are paid to trade well, right? So always remember that you need to focus on quality over quantity. Number three, expect about two setups per day, right? On average, you will find roughly two good setups per day based on candle ranges and CRT. This could either be a reversal or a continuation CRT trade. But here you need to remember that the key is patience, right? You are not out there hunting for dozens of trades. You are waiting for high probability setups that actually aligns with your high time frame drawn liquidity. Right? So the premise is stick to your plan at all times and don't just force trade just because the market is open. Moving on, here's another golden rule. The more high time frame ideas you can use to support your intraday setups, the better your trades will play out. Why? Because the higher time frames like the daily and the 4 hour shows you the bigger picture. If your intraday setups lines with a strong higher time frame drawn liquidity or key level, the odds of success go way up, right? So always keep an eye on the higher time frame to confirm your setups. Another key point is that key levels, high time frame drawn liquidity, and 4-hour CRT or candle ranges form the foundation of your intraday trading. And next up, some days you don't trade at all, period. Big news events like FOMC, NFP, and CPI create too much unpredictability, right? And the market tends to go wild. And on these days, the best decision you can make is to stay out and protect your account, right? Because being a good trader isn't just about knowing when to trade, it's also about knowing when not to trade, right? And we'll discuss this in the next chapters. Now, let's move on to the next slide and let's talk about framing intraday setups, right? Now, down here you can see all the factors and variables you will be thoroughly considering when framing an intraday setup. First of all, we've got higher time frame drawn liquidity. You're going to be making sure that the higher time frame drawn liquidity is always aligned with your intraday setup, because the higher time frame always shows the bigger and the cleaner picture. And if the trade is aligned with the higher time frame drawn liquidity, the odds of success are much higher. So your first and main priority is to make sure only to take trades that are in the direction of the high time frame drawn liquidity, right? Now, yes, I know that I keep repeating and reminding you of the high time frame drawn liquidity, but that should tell you enough about how important it is, right? And how significant it is. There's a reason why I'm keep repeating the same shit about drawn liquidity, because I know how important it is and how big of a crucial and important role it plays in your setup, right? So remember this at all times. The next is higher time frame order flow. Now this one is almost the same as the higher time frame drawn liquidity, but this just adds another layer over that by letting you know how the short term and the intermediate and long term highs and lows are influencing the market structure and how you should be approaching them appropriately. Third one is the weekly candles direction. What you're going to do is you're going to do your higher time frame analysis and determine how the weekly candle is going to pan out and in which particular direction is it going to close and expand. And then you're going to make sure to position yourself only in that particular direction. Next up, we've got the most important part, which is CRT or candle ranges, right? This is the building block of your intraday setup, and without it, you will never be able to frame a mechanical entry in an objective manner. You're gonna make sure to select the correct CRT or candle range on the 4-hour time frame, and then try to frame setup around that CRT in the direction of the higher time frame drawn liquidity. And then next up, we have for our key levels. Now, obviously, if you've been through my breakdowns in content, you would know that how important key levels are, right? These are the building blocks of our whole analysis, right? So, key levels are also important. Then we have the day of the week, right? Each day of the week has different characteristics and different scenarios it can play out based on the framework of key level, order flow, and drawn liquidity. And you must be aware of all the scenarios and then act accordingly based on the structure and framework you are dealing with. Then we've got the time of the day, right? I'll explain this later in the video, but remember this is also important. And then last but not least, we've got range expansion. Range expansion is basically knowing when, how, and where the range is going to expand, right? Meaning when is price going to break out of it to form an extended swing in the direction of the high time frame drawn liquidity. And for that, you're going to build a cohesive and logical narrative around it through the concept that I've taught you, and that will guide you to the correct range expansion at the correct time, at the correct key time. So moving on, time of the day. In this slide, we'll discuss the different times of the day that you must be aware of for you to trade properly and frame precise entries during the day. We've got all these different times of the day. We've got the Asian session open, the London session open, London lunch, New York session, and then last but not least, the London close kill zone or session. Each one of these different sessions or kill zones or times of the day have their own specific characteristics, features, and details. And I'm sure you must be aware of all of them because I've taught you and explained them to you in the previous chapters. For example, the Asian sessions tends to be a ranging profile commonly known as the Asian range, and then based on the Asian session, order flow, and high time frame key levels, London session can have its own properties, right? It can react in different way based on the framework and structure that we are dealing with. If we've not tested a key level or a high time frame candle range has not yet been purged during the Asian session, then London session often tends to be a manipulation profile or a Judas swing where it tests the key level and then expands in the opposite direction. Right? So it basically depends upon the framework that you are working with. And then based on that framework and structure, it can have different conclusions or result, right? And the same goes with the rest of the session. Now moving on, let's break down the day of the week characteristics and how they impact our intraday trading. Now we know that each trading day has its own unique behavior, and knowing these behaviors and these different features, they can give you an edge in planning your trades, right? The market doesn't behave the same way every day. Each day brings its own unique setup and its own unique structure and framework. And understanding these differences can help you align your system with the market's rhythm. Now let's go over the key factors in how each day plays out in trading week. First, let's talk about the framework we are working with. When analyzing each day of the week, there are a few core variables you always need to keep in mind, and they are order flow, key levels, candle ranges, market profiles, and weekly profiles. Right now, Monday often acts as a range establishing day. Right, you might see the creation of a candle range or a CRD, which becomes an important reference point for the rest of the week. Right, it's not the best day for aggressive entry trading, but it's great for observing and marking key levels for the upcoming days throughout the week. Then we've got Tuesday. Tuesday is when the market starts to pick up some momentum, making it a good day for intraday trading, right? And the range from Monday can help guide your setups as Tuesdays often expands on Monday structure. Order flow becomes clearer and opportunities start to appear. Then we've got Wednesday. Wednesday is one of the best days for intraday trading. By midweek, the market has usually developed enough structure key levels ranges in order flow to make high probability trades, right? And the volatility tends to be just right, enough to create opportunities, but not so chaotic that it's hard to manage risk. And then, like Wednesday, Thursday is also ideal for day trading. You often see continuation of trends that started earlier the week, or maybe a reversal if we have reached an opposing high time frame key level, or if the weekly range expansion has been completed, right? And the key levels established earlier in the week becomes even more significant, and Thursday is your chance to take advantage of them. And then we've got Friday. Friday are often a risk off day, or meaning a day with limited opportunities. You could still trade it if the weekly range expansion hasn't yet fully extended, or if the weekly objective hasn't been met, right? And the better you understand this structure framework and how each day fits into it, the more precise and confident your trades will be. Now let's move over to the next part of the chapter. In this last part, I will define the daily range to you based on time and kilozones, and I will show you how each session is coordinated and how different factors and variables plays a role in the structuring and coordination. So moving on, let's get into what ICT trading day really means and why it's important to approach it with the right perspective, right? This concept can make a big difference in how you analyze the market. So the retail trading day starts at 5 p.m. Eastern Standard Time and ends at 5 p.m. EST the following day, right? Or you could say that it starts at 17 Eastern Standard Time and ends at 17 Eastern Standard Time. Now, by following this schedule instead of a standard midnight to midnight approach, you are able to see price movement in a way that's more aligned with how the market actually operates. It gives you a more precise view of the whole daily range in terms of the different kill zones and sessions, and you'll see this in just a minute. Moving on, first of all, let's talk about the Asian range, what it is, when it happens, and how it influences the market behavior. Now we've got the timing of the Asian range. The Asian range begins at 8 p.m. Eastern Standard Time or 20 Eastern Standard Time and ends at midnight or 0 Standard Time, Eastern Standard Time, you could say. The Asian range often sets the tone for the early part of the trading day, right? While we know that this session typically has lower volatility compared to the other sessions, it's important because it creates an important structural framework that we can use as a guide to plan our trades throughout the rest of the day. That's why Asian range is so important. Uh, we know that the Asian range often represent a period of consolidation, right, where price moves within a narrow range, right, and this is where liquidity is being built up, and it is setting the stage for a potential expansion during the London kill zone or maybe during the New Year kill zone, and we can use the Asian range price action as a guide for us. Now there are two profiles, main profiles that can emerge based on the orientation of the Asian range. First of all, we got the delay protraction profile, which happens when the Asian range is an expansion profile, and then we have the normal protraction profile, which happens more often than the other one, and it's when the Asian range is a consolidation, and then during the London kill zone, we have a manipulation above or below the Asian range depending upon the high time frame down liquidity and key levels, and then we expand in the opposing or the opposite direction. To use the Asian range, what we do is we mark the high and the low of the Asian range on our chart as soon as it's established, right? And then these levels often act as a key reference for later sessions. And what you're going to do is you're going to pay attention to how price behaves around the Asian range and the candle ranges on the 4 hour during the London Opal kill zone, right? You're going to recognize where the market is showing signs of a delayed or a normal protection profile, and then you're going to adjust accordingly. All right, now moving on, let's break down the London kill zone. Timing of the London kill zone, it starts at 2 a.m. Eastern time, Standard Time, and then it ends at 5 a.m. Eastern Standard Time. Now, during this time, the market tends to break out of the consolidation range it formed earlier during the Asian session, right? It also tests key level during this time and establishes the daily directional buys, right? Now, the way the London session expands is heavily influenced by what happens during the Asian range, and also other facts like candle ranges and key levels, right? And here is how it typically plays out. If the Asian session didn't reach or test a higher time frame key level, the London session often forms a judo swing or a manipulation profile and then reverses to expand in the opposite direction. And if the Asian session has already tested a higher time frame key level and has already purged a 4 hour candle range, then the London session is more likely to expand in the same direction without having any manipulation profile, right? And when the London session takes out a candle range, either from the Asian session or the previous day, this often signals a high probability time for those ranges to be purged or cleared out, and we can then frame our setup around it, right? That is what you need to know about the London kill zone. Now let's move on to the next slide. Here in this slide, we'll discuss the New Year kill zone. Now the New Year kill zone starts at 7 a.m. Eastern Standard Time, and then it ends at 10 a.m. Eastern Standard Time. Now the price action during the New Year kill zone is majorly influenced by the progress made during the London session or the London Opal kill zone. And based on that structural framework and price action, we can have two main profiles. We can either have a continuation profile or a reversal profile during the not London, the New Year kill zone. If the London session has not yet reached the daily objective, for example, it hasn't yet tested an opposing key level or taken out an opposing liquidity pool or liquidity zone, or the range expansion hasn't yet fully been extended, then the New Year kill zone is likely to continue the trend that was established during the London session. And if the London session has already reached the daily objective, meaning it has reached an opposing key level or taken out a liquidity pool, then the New Year kill zone is more likely to trigger a reversal, right? And in this case, price might manipulate early traders into thinking that the trend will continue and it will create a false breakout or a liquidity grab, and after that the market will reverse in the opposite direction, right? Either after a consolidation or straight away a reversal will happen. Those were the features and profiles that New York session upholds. Next up we've got is the London close kill zone. It begins at 10 a.m. Eastern Standard Time, right? Right after New York kill zone ends, and it closes at 12 a.m. Eastern Standard Time, not 12 a.m., 12 p.m. Eastern Standard Time. And it has its own intricacies and details that we'll get into in a in a future chapter. Now moving on to the next slide. Here in this slide, you can see this price action chart, and based on this price action, I will define the daily range to you based on the time of the day and kill zones. So first of all, you can see that I've already plotted out the open and close of the day, right? It's a 15-minute chart right here, and here's something important that I want to tell you as well. During the day, you're going to make sure to mark out the open and close of each day, right? And I've already told you before what are the open and closing time. It's the 17 Eastern Standard Time or the 5 p.m. Eastern Standard Time, right? The reason why you're going to do that is going to basically give you a structural framework within which you're going to plot out your Asian session and the other kill zone, which will make you easier for you to dissect them and see how each one is playing out. And then based on that, your decision making process would be a lot more efficient, and you'd be able to to frame trades more efficiently and more easily in a simple and an objective and mechanical manner. So first of all, you can see right here is that we have this consolidation profile during the Asian session, which makes it an Asian range. And let's say right above here we have a higher time frame key level, and you can see during the Asian session we never tested the higher time frame key level, right? And instead we formed a ranging profile and generated liquidity. And then during London kill zone, you can see that based on the structural framework of the Asian session, what we did is we had a manipulation profile or a Judas swing higher, and with that we tested the higher time frame key level above us. We took out the Asian range liquidity that we had built, and then during the London lunch, we expanded and reversed lower, right? Now during New Year kill zone, we still hadn't yet reached the higher time frame objective, or we hadn't taken out higher time frame liquidity, so we continued that trend even lower, right? And then during New Year kill zone, you can see that we reached down there and we reached the higher time frame drawn liquidity, or we tested in opposing higher time frame key level. And after that, you know that based on that structural framework, New York often tends to be a reversal if that is true. And then you can see New York actually, after expanding in the first half of its kill zone or session, it then reversed after reaching the round liquidity. And then during the London close kill zone, we continued that reversal from the earlier New York session or kill zone, and we closed the day higher, right? So you can see based on these times of the day in kill zones and the Asian session and its orientation, you can see this price action a lot more clearly as compared to if you had been looking at with the naked eye without these annotations or without these opening and closing prices. This is how you define a daily range, and this way you'll be able to easily frame a setup around it, and it won't be that hard for you, right? So when you start your day, first of all, you're going to plot out your opening and closing times, and then as soon as the Asian session is established, you're going to mark it out, annotate it on the charts, and marks out at high and low, and then look at it based on high time frame key levels and down liquidity, and then make decisions based on that. And basically the Asian session will act as a guideline or a guide for you, as a reference point for you to make decisions based on it during the London kill zone and during the New York kill zone, right? That's what you're going to do. That is it for the chapter.